Hi, everyone. Welcome to the third edition of the Mosaic podcast. And I am your host, Mpumulo Piane, Chief Economist here at Alexforbes. And I am joined by the lovely Head of Asset Allocation, Mandisa Zavala. Mandisa, I just want to get straight into it.
Really?
Yes,
You don't want us to
straight.
ease into
No,
it?
no easing into it. Like literally
Okay.
how we started off the year,
Yeah.
right? With a bang,
Yeah.
right? And it just feels like we've been in crisis management mode week after week with short, smoke breaks
Yes.
like we had last week with the budget, you know. But other than that, it has been one overwhelming headline
Yeah.
after the other,
Yeah.
right? And we are in the thick of things with the Middle East conflict at the moment. And I must admit that the ongoing conflict that we are seeing happening in Iran, it has been worse than what we initially anticipated.
Sure, 100%.
Along with many other analysts, right? So that has caught us by surprise, like the extent of the conflict. I mean, this has been a tail risk that we've been talking about for years, right? I mean, I remember from 2024, if not earlier, like this is a risk that we have been talking about over and over again. But we had said that there's a major deterrence, and especially this year, we said that, the major deterrence here for a continued escalation and a regime change is that it would have far-reaching ramifications for oil prices, and that would also have an impact in terms of how midterm elections play out in November, right? But nonetheless, this is where we find ourselves. The situation remains very fluid. For us, the key question we are asking ourselves, beyond the knee-jerk reaction that we've seen sending oil prices to $85 a barrel, what we are asking ourselves is three questions. Firstly, how long will the conflict last? Whether there will be any damage to oil infrastructure, and whether shipments through the Strait of Hormuz will continue to flow. I think, those are the key fundamental questions that we are asking ourselves, because it does change how we're thinking about scenarios, our baseline versus scenarios. From a market perspective, how are you thinking about it?
So, I mean, like what you said, we are at another bang. Seems like it's just bang, bang. And we need the bangs to stop right now. And, it's a very serious situation, like you mentioned. People are losing their lives.
Yes.
And, we don't want to take that for granted. And what has happened is we've actually seen a response from markets. Not necessarily, I think we were chatting earlier, and I was saying, the extent of the response, especially last yesterday, was not as big as it has been historically when we had, on Liberation Day, or we had the Ukraine-Russia war. I think there was a little bit of a delay in how markets are sort of taking in what is happening. And even if you look at things like, we recently had a look at the US 10-year, the level at which it's risen are not levels that are beyond 5%. At the current moment,
Yes,
because
as
maybe
we
as we speak, because perhaps by the time we release this, it might be different.
Or by the time we finish recording.
By the time we finish this, it might be different, because things are just, like you said, fluid. They're just forever changing. And where we sit right now within markets is that initial reaction. We've seen investors are cutting. They risk on average. They're trying to raise liquidity. They're fleeing away from asset classes that are perceived to be of higher beta exposures, your emerging markets, and they're just scrambling to also get some hedges within their portfolios. What we tend to see is, over time, when you experience a shock, is the market then goes into the second phase, where they start to then take in the fundamentals.
Yes.
And this is where we start to see divergence, where really, I think Warren Buffett says, when the tide goes out, you'll see who's swimming naked. I think that's when you see actually other people didn't actually have, proper proper hedges in place. They were not properly diversified. They didn't have portfolios that sort of stood the test of time. And you also start to see portfolios starting to take flesh as well, starting to come into fruition. And people will then take views on, do I get into the trade that, some things have fallen off? Do I then sit in value sort of stocks, or do I sort of go into the stocks that are maybe performing quite well? And it's going to be an interesting, environment as we see this play out. I think, as I'd said to you earlier, I was thinking, oh, by Friday, we're back, we're back to business. But I think the level at which this particular event is occurring, even the extent at which people are losing their lives, is making us realize that it's a lot more serious than even that first one that happened last year. And so, last year. And so it does warrant us sitting down and analyzing what we have at our disposal. And I think, just to sort of close off the market outlook, there are three things, and I think these are going to be the most critical things that any participant needs to look out for when you're conducting or you're putting together a portfolio. The first one is what inflation expectations are going to do. If those become unanchored and participants start to believe that perhaps inflation is going to be higher on the back of your comment around the oil price, that is going to be worth changing strategy. And I think these are sort of strategic things, not the noise, because again, you can't trade on noise, but these are strategic things you need to look out for. Financial conditions and stress indicators, things like credit spreads. Are those spreading? Are those actually responding in ways that are signaling that we actually have a credit event that might occur because of what is going on? And also the rates market pricing as well. What is the market saying around what is going to be priced in with regards to the interest rate cycle going forward? And this is not just for the US, but it's for the global economy as a whole. So if these three things start to change, those are strategic things that we think warrant you going, okay, I need to now take a step back and look at my portfolio and maybe make adjustments. In the absence of any of these things changing, we would argue that perhaps be a lot more measured in your approach. I know we've done some work on some scenarios that could likely play out over the next couple of months, and perhaps over the next 12 months, and what that might mean for portfolios. So perhaps it might be worthwhile taking everyone that's listening through those.
All right. Yeah, I mean, I think, during times like this, where things are so fluid, we find value in that scenario mapping, right? Because it does help us navigate the changing environment. And I think fundamentals, like as you pointed out, those remain very important. Beyond the market headlines, we need to look at what's happening to fundamentals. So what's been quite interesting for us, I must mention, like at the beginning of the year, when we sat and we were presenting in our various committees, what we had mapped out also from that scenario analysis, right, from a baseline view and a bull scenario playing out in the market, we had placed that at about 80% probability of playing out. So we thought the baseline scenario and the bull scenario combined have an 80% probability of playing out.
I see,
the base scenario, which being that risk-off environment and, a major oil shock, we put that at around 20%. But, the developments over last week and this week in particular has made us realize that actually that base scenario has a much higher probability of playing out. So we now think that that has a probability of about 40% in terms of playing out versus the baseline and bull scenario, which now we think has a combined 60% probability of playing out, right? So, that just highlights that the has been an increase in that base scenario playing out.
2 times as much. I mean,
yes,
literally 2
right.
times as much as what we thought just a few weeks ago.
Right. Literally. And, to just take you through the baseline scenario, and then we'll get into each of these other scenarios, and, to also just, let you know, like we have 2 base scenarios actually, just given how we're thinking about how things could play out, right? So like in the baseline scenario, we still think that there is cause for de-escalation. And the reason we say that is because we have midterm elections in November. a sustained conflict that results in a major oil shock would have significant ramifications for the results of the midterm elections. We think that continues to anchor the de-escalation scenario. Despite the ongoing conflict, we think that there is still cause for de-escalation. And then in that scenario, it means that this ongoing conflict could play out, between anything from 1 week to 4 weeks. Within a month, we could still get that de-escalation despite the currently noisy headlines that we are seeing. What that means for oil prices is that, beyond the initial surge in oil prices we are seeing, if we do get an announcement of a ceasefire, then oil prices could revert back to that 60 to 65 range that we have been expecting at the beginning of the year, because the current supply disruptions would be short-lived, and then we would see that supply coming back online. Your demand and supply dynamics would then determine where your oil prices then revert back to. What that means for inflation and monetary policy, it essentially means that the global disinflation pretty much remains in place, but it is temporarily disrupted, right? What that means for monetary policy, and I think this is also important, because coming into the year, we did acknowledge that there's just little bit of easing still left on the table, right? We were still expecting that the Fed will ease in the second half of the year. We thought the ECB is done, and then we thought the BOE will continue to manage the gradual easing. So what that essentially means is that any cuts that were penciled in for March in particular, that gets pushed out to the second quarter. And then anything that was penciled in the second quarter then gets pushed out to the second half of the year. So essentially, disinflation temporarily disrupted, but continues. Monetary policy easing just gets pushed out to later in the year, but pretty much remains on track. In that scenario, I'd be very interested to, get your sense in terms of how you think the market, would react, equities, bonds, and, from a DAA positioning, what would that essentially mean?
So I think we'd need to take it from where we are right now. So markets have fallen. Markets are continuing to fall right now because they're trying to assess the risk and trying to figure out how to actually position for it. So a lot of the risk assets have actually taken a huge knock and hit. If we see the scenario playing out where there is the de-escalation and you have oil prices going back to 60 to 65, like you mentioned, and monetary policy still being more or less the same, just with a bit of a delay, you get some stabilization coming into the stock market. We do expect that after this happens, that the market then starts to look for emerging markets again, because I think right now, there is that flee towards safety. So you want your deep quality, your defensives types of asset classes. And so emerging markets are definitely the first one to sort of take the brunt and the hit. But we likely think that this comes back again towards the, in an environment where, or a couple of months later, people feel comfortable again adding risk into their portfolios. And, we go back to status quo. With developed market bonds, I think we have seen more recently, or rather with the recent market reaction, yields spiking up slightly, only slightly, not necessarily to levels that are very, very concerning. But we expect that perhaps from an early on perspective, you may find that yields start to pull down because there's a little bit of comfort that comes through. But again, there's going to be that flee again towards we want carry, because at the end of the day, you still want something that's going to perform quite well in your portfolio. So credit comes back into vogue. Emerging market bonds become even more attractive because now you're not seeing any risks towards inflation. So yeah, in general, that's what we would expect when it comes to global markets and how they react from a fixed income and equity perspective. How we would react from a portfolio positioning now, or dynamic asset allocation positioning, would then be just introducing still some core resilience. So you want to make sure that you still are participating in the uplift. So you don't want to be making a lot of changes into your portfolio, but things like if you had had liquidity and cash, you probably want to make sure that you sort of keep it there in the first part, but you utilize it going into the latter end of the year where necessary. In other words, you're buying more emerging markets, especially those that would have then fallen off a cliff, because in essence, you want to be buying those that that will be driven up as markets start to recalibrate that risk out. You want to make sure that you have enough gold, because I think even though you may see a little bit of a decline in gold as everyone starts to realize that perhaps the risk of an outright prolonged war like Russia and Ukraine is no longer in the system, you still need something like gold to come in, because we still have tariffs, we still have Trump at the helm, we still have US elections coming in. So you probably still want your portfolio directed towards those types of asset classes that provide good hedges in environments like that. Maybe we can touch on the bear, because I think you spoke a little bit about that. And it's interesting, you said we've got 1 and 2. We've got bear 1 and bear 2.
Yeah.
We'll discuss it as one, but maybe kind of give us an idea of also just some of the changes that would occur when we move from bear 1 to bear 2.
Yeah, so I mean, we thought we should recognize two significant bear scenarios that could play out. The Strait of Hormuz could be closed. At the moment, it hasn't been closed as we speak, but shipments around the Strait of Hormuz have slowed because of the increased shipping risk associated with moving the cargo currently, given the ongoing conflict, right? So that's the one risk, that there's a complete close. And the Strait of Hormuz is quite important because it accounts for about a fifth of oil shipments. Seaborne shipments do pass through the Strait of Hormuz. Gas also, large quantities of gas also do pass through the Strait of Hormuz, right? So it is quite an important choke point for the energy market, and hence we continue to monitor the developments around that, right? So that's like major tail risk that we continue to monitor. But another risk as well is with the ongoing conflict, and reports already that the Iran supreme leader has been killed, right? It does call into question in terms of who's then going to be stepping up to take over. We do think that the risk of miscalculation there with regime change is that you could get a regime that does not have a positive posturing towards the US and towards the West in general, and you could continue to see conflict, and that essentially increases that risk around the shipping route, right? So as I was mentioning earlier, is that the one risk is that there's a complete halt of shipments there, and even though that has not been the position of Iran at the moment, ships have slowed because of the associated shipping risk, right? So you do get in Bear 1, we see that repricing of risk, which makes shipments around that route quite risky to cover from an insurance perspective. That then requires some rerouting, which is not going to come cheap, right? Because now ships have to take a longer route. So there's just an overall repricing of risk given the ongoing conflict there, and then also given the required rerouting to continue shipping oil. And then in Bear 2, it is that risk of the Strait of Hormuz being closed. But overall, what this means is that oil prices surge to around 90%. They do get sustained at those high levels for quite some time. But demand to those high oil prices also responds, right? Because everything is demand and supply. If supply is being constrained, leading to higher prices, then demand is also going to respond to that, right? Because remember, higher oil prices do hit the consumer
Absolutely.
quite directly. Fuel is a lot costlier.
Oh, we know that.
You're spending you're spending more, which is then exacerbated by the currency impact as well. As you were mentioning that in the initial reaction, emerging markets would be affected. So you have this double whammy: higher oil prices, weaker currencies. It hits consumer pockets, it hits consumption. So in addition to that, you also get this hit in food prices because food gets transported by road transport. But essentially, the point I'm making here is that oil prices initially increase, but demand also responds to that. So then, over a longer period, 18 to 2 months, you then get that balance again in demand and supply. So then your oil price then tapers back to around 70 to 75. So, just keep in mind that it is also higher than, that range we have in the baseline scenario. So, that's how we're thinking about the Bay 1 scenario. In Bay 2 scenario, we, get this jump to like oil goes to like 120 US dollars a barrel, given the choke point and limited flows from through the Strait of Hormuz. So what that essentially means is that in Bay 1 scenario, it removes any further monetary policy easing because it would be inflationary. But in Bay 2 scenario, what that does is it not only does it remove further cuts from the table, but central banks now begin to talk about monetary policy tightening because they would be concerned about that second round impact in inflation expectations, right, and in headline inflation, because you are beginning to see that higher oil price feeding into other things as well. And workers also now beginning to demand higher wages. So, once you get that inflationary feed through loop, that, completely puts further easing off the table, and central banks now begin to talk about monetary policy tightening. So from where we're sitting, the two base scenarios do sound different to the baseline scenario. Are you seeing a similar thing playing out in, from a market perspective?
So it is also a little bit nuanced, but more or less in the same direction. So I think under the scenario that you've described, which is the Bay 1 scenario, we probably are still going to be seeing an environment where we're still seeing some derating happening, especially within emerging markets. We think the DM space is a little bit more nuanced because you have your Europe and parts of Asia that are more geared towards the energy trade, and that becomes a lot more adverse for them. But perhaps in this kind of environment, markets like the US actually on a relative basis actually look slightly better. I think the other thing to also take into account is under these two scenarios, you've got US strength that is coming to the fore. We haven't had that for quite some time, and that's actually been US weakness has been a tailwind for emerging markets. So once you remove that tailwind, you get headwinds essentially, and that essentially becomes quite critical. So tighter financial conditions just by the fact that the dollar is strengthening, and that becomes a bit of a spanner in the works. If you look at what happens under the Bay 2 scenario, still more of the same thing, but EMs get hit a lot more worse. And so, in essence, the market, especially with market participants, they start to question things like, are we in a high inflation environment, low growth? So stagflationary risks. And under stagflationary risks, markets tend to not, especially risk assets, they do not do well. They do not like stagflationary risks. And so it is a very, very concerning scenario. If you look at global bonds have not been a hedge for equities outright for the last couple of years. So I wouldn't necessarily say, that they'll probably do well. I think you'll probably need to sort of play that trade on an active basis, maybe more on the shorter end than you are on the longer end. I think it's going to be one that will be seen really as it sort of goes on. But nonetheless, you probably on a net basis, you might prefer fixed income over what you would on the credit side. So credit and EM spreads are likely going to be more hit. And then if you think about what we would do from a DAA perspective, you probably want to be de-risking in an environment like this under Bay 1 and Bay 2, because if it's more protracted, then the concerns are where is the trough, and the market can take a long time to find the trough. Now, my biggest concern with this is we do have markets that are currently very expensive, like US and in particular US tech, and markets that are expensive tend to actually have a lot more bigger dips. So again, that's why I say perhaps also the fluidity also comes in from an AA perspective, where you also have to be data dependent like the Fed, because it's not outright, let's go to the US and hide there. It's where are you going to the US in order to hide? Because again, you can't be going to the US and going to an expensive market under an environment of de-risking. People actually flee away from those kind of asset classes. So scenario long protracted also does mean you have more cash in your portfolio, but I still think gold still remains a good idea under a scenario like this. And probably hedging becomes even more critical. And, within our portfolios, we do go into hedging strategies. And I think in this case, you actually want your managers to come through to the fore because they'll be able to navigate an environment like that and hopefully get some alpha there.
Yeah, I mean, I think this type of situation, it's again a reinforcement that purposeful diversification remains quite key, because these type of calls are very difficult to call, very difficult to price, and that's why what we offer in terms of purposeful diversification is quite important in this environment. I'd like to turn the discussion a bit towards South Africa, a very brief discussion. I mean, on the global side, we didn't really talk about anything else because the geopolitics is going to drive macro going forward. What has happened so far really doesn't matter. It becomes more about the outlook, right? But for South Africa, we had a positive budget, which was pretty much in line with our expectations. I think the major positive thing there was the fiscal drag reprieve that we were offered with, income tax brackets being adjusted for inflation. But overall, positive budget, which continues to affirm fiscal consolidation. But unfortunately, the risk here is this geopolitics that we've been talking about. And, it could have said that positive sentiment that we were, gradually beginning to see on the SA side, right? So, similarly to emerging markets, we have been discussing what this essentially means is that, in that baseline scenario that we discussed, where there's de-escalation, disinflation temporarily disrupted, but, remains pretty much on track. That essentially means that the March rate cut that we were expecting from the SAP also gets pushed out, right, to the second quarter. And then the other cut also then gets pushed out to the third quarter as well, right? So, delayed easing, but it does not put easing off the table. In the Bay 1, scenario, we think that the sub stop easing because it becomes an inflationary environment. But in the Bay 2 scenario, then the SAP puts monetary policy tightening on the table. From that perspective, just at a high level, how would you be thinking about, the market reaction as well as DAA positioning?
So under base scenario, you have resources still doing well. They will take a hit because those are commodities and there is some element of risk tied to them, which is what we're seeing right now playing out in the market, where we're seeing some volatility happening there. But on a net basis, you probably want to still be positioned towards your resources because they are tied towards the gold trade. You want to be perhaps also careful around where you're positioning when it comes to things like your South African bonds, because South African bonds do also tend to be quite high beta. So in the beginning, we expect that it will decline, or rather the trades returns will decline. But in essence, SA bonds are still offering quite good forward-looking fundamentals. You spoke about a very good budget. All of those things are still in play. But if the global environment still remains quite tricky, we may see a little bit of a stabilization on that front. But we see bonds still being okay if we go back to neutrality. You maybe might want to add on some rand hedges to the portfolio because they add as stabilizers. We don't need to add anything because we do have enough of those in the portfolios. And I think from a DA perspective, we maintain our core stance. If you do have some money that has been sitting to the side and that's coming into your portfolio as an investor, then you can still look at putting that on the side towards your cash just to even out your risk, or even towards gold. Under the bear scenario, I think in that environment you do want to de-risk. We do think South Africa will be susceptible to the global environment, to the global volatility that's happening. You talked about the SARB and the fact that they may even put back tightening on the table. I think that's an environment that is going to be tricky from an SA Inc. perspective. So you probably want to actually pale back, sit in your SA cash. You might want to consider South African inflation-linked bonds, because in an environment like that, if inflation is going up, that actually is an asset class that does really well. And I do think, and I'm gonna take out a limb and say gold, because gold from a global perspective actually still maintains its performance in it remaining as a hedge. You probably still want to have a little bit of exposure towards your gold miners. Be careful in terms of be balanced around that, but you maybe want to take that into account. So I feel like that would be a portfolio that is probably a lot more robust to weather the system. But I think key to what you said, you want to be diversified, because we don't have a crystal ball that we can sort of tell everyone here this is what's going to happen. So you want to be diversified across the spectrum, and that is what we're doing right now. It's the only free lunch that we have
in town. Yeah, diversification is the only free lunch in town. Yeah, I'm happy for us to leave it there. We will circle back next month, and cheers till then.